Dhiraj Agarwal is Managing Director at Ambit Investment Managers. Dhiraj, good morning. Good to have you back on the show. Thank you for your time. What's the view now, Dhiraj? Have 12% in 9 days on the Nifty. And, you're again, gains come so quickly, you just snap back that you're left wondering, what now? I mean, and stocks uniformly are up 20-25%. I'm talking about, say, BSE 200 or a well-tracked group of stocks. What's your view from here?
Yeah, so if you actually zoom out a little bit and ignore the fast down and fast up moves, market continues to be in a large struggle zone, right? So it falls very fast, it comes back very fast without actually going anywhere. So the last time I think we discussed on your show, I basically said, look for 1 or 2 years of just single-digit kind of returns. And I think I maintain that view. But it will be through bouts of optimism and pessimism where we will see sharp moves on both sides. So it's not one of those kind of markets where you'll see a vertical down kind of a correction. For that, you need some big shock to happen. I mean, the tariff issues could have provided that shock, but India looks like a bit of an island of safety or oasis of safety within the whole tariff war, which is currently going on. So I broadly maintain it's a large range market. We will keep on doing top of the range and bottom of the range many times before the mean reversion actually happens.
So continue to be a little cautious in the market. Dhiraj, good to have you with us on the show this morning. Now, so what is the issue? And for a second, I'm just leaving aside this entire trade uncertainty and whatever's happening with tariffs. Hopefully, we'll get a better deal. At least that's what the market believes, right? That India will probably get a much better deal than a lot of other countries. That aside, why else are you far more cautious? Is it that you're not convinced about this whole earnings recovery story? Is it something else?
So two things, Surbhi. One is you can't fully ignore this whole tariff issue, right? Because to my mind, one thing is very clear: the current disruption or change in the global financial order, the global trade order, which is happening, has two clear implications. One clear implication is there will be a slowdown in global economy. Now, we will have to wait and see whether the slowdown is shallow or deep, whether it becomes a full-blown recession. But I think it's pretty much a given there'll be a slowdown in the global economy, and India can't remain fully protected or shielded from the fact that the global economy itself will slow down. So that is point one. Point two, domestic economy itself has been slowing down for the last few quarters. I mean, we can see that in the top line of Nifty or BSE 500 earnings. Bottom line has been telling a different story because of the margin uptake which happened for a few quarters. But the top line growth has been anemic in the region of 7 or 8%. Domestic economy has been slowing down. So if you add on top of a slowing domestic economy, a layer that the global economy will also slow down in the next few quarters, I think earnings will see more cuts. So as you rightly mentioned when you were discussing one of the stocks that brokers are downgrading because of valuations despite okayish earnings. So that's the challenge. When where the earnings are okayish, valuations are too high. Other places we are seeing a little bit of earnings downward pressure. So both these two things will keep the market in a bit of a struggle zone, I think, for some more time to come, and according to another year or so.
So, Dhiraj, where are you on earnings, if I could just ask? Because the street consensus, when we kind of began, FY26 was supposed to be somewhere around 12 to 14%, depending on whom you're listening to. What is your base case expectation?
So this is just a very, very top-down guesstimate. I don't have estimates. So very, very top-down guesstimate looking at the way cuts are still happening in many, many spaces despite good results. I would say we would end FY26 in high single-digit range. So 7, 8, 9, that kind of a range.
And that's not in the price, is it, Dhiraj? 7 to 9% earnings growth this year. That's not in current stock prices, is it? Or is it?
I don't think it is. I don't think it is in the because that level of earnings disappointment is bound to slow things down, right? So I mean, there are two things which are playing in the market. So one is the narrative of what is happening on the global scene. Second is the actuals, which is the earnings. And in the near term, India actually benefits from the narrative that India is an oasis of safety in the tariff war. India has a very good relationship with the US, and we are trying, and that's a fantastic job achieved on diplomacy by the current government to do a trade deal with the US fast. And as a supply chain alternative, this is the third time in the last 17 years that we are staring at a wonderful opportunity of making India a supply chain destination. Whether this time we are able to do it or not is a question we will see going forward. But these three narratives are playing on the positive sentiment on the market. But if you look at the earnings itself, weakish, nothing to write home about. And there's no upward revision in any of the earnings which are coming out. Either it's flat or we are seeing downward revisions.
Okay. All right. That's a sobering thought and one we must take on board. And perhaps eventually they say earnings is the fuel of every market. And if we're looking at more cuts ahead, it could be maybe a little problematic. All right. Got it. Thank you very much, Dhiraj. Good perspective this morning. Appreciate you joining us on the show.